For the average person, the number one chance they have of becoming rich is through investing. When some people think of investing, they think of day traders on the stock market floor making deals continuously for hours on end. However, this is not how most investors grow their fortunes. In fact, the rich in particular follow specific investing principles that allow them to increase their wealth year over year. And in this video, I will share with you 5 investing principles only rich people know. And if you're new to the channel, then hit the subscribe button below for more life-changing content. When it comes to building wealth, investing is the ultimate means of doing so. It's been proven time and time again that with consistent investing efforts over numerous decades, anyone can become a millionaire and enjoy financial success in their later years. However, like any long-term endeavor, there are usually challenges along the way. In fact, besides knowing the investing principles that must be followed to ensure their success, the rich also know exactly which mistakes to avoid, which is equally as important. These mistakes can foil the progress of any investor, which is why before we get into the 5 investing principles you need to master to be rich, I will first go over a few investing mistakes you must avoid at all costs. The first mistake is being an emotional investor. If you allow your emotions to affect your investment decisions, you will be guaranteed to struggle in your money-making journey. Successful investors have mastered the art of being logical above being emotional. There will be days where you will be tempted to fall victim to your emotions, but those days must be very few. Greed and fear must be avoided if you want to achieve your goal of financial independence. You can't succumb to the temptation of short-term profits, but instead must stick to the course of seeking long-term returns. The second mistake you must avoid is trying to time the market. Market timing is an investment strategy in which you move in and out of a financial market in order to buy low and sell high. It has to do with switching between asset classes by predicting the next turn of events through the use of economic data or technical indicators. Many investors believe that they can make a lot of money timing the market, and they're right. However, it's easier said than done. In other words, market timing looks easy to handle, but it is difficult in reality. Even professional financial institutions who have been studying market trends for decades cannot claim to have mastered the art of market timing. Hence, you will be taking a big risk by approaching investment with a market timing strategy. Any experienced investor who is sincere will blatantly tell you that it is impossible to successfully time the market in the long run, and studies support the counter strategy of investing for the long term. Investors who keep their money in stocks and bonds and let their investments grow over time tend to perform just as well, if not better, than those who try and time the market. The third mistake is lacking investing patience. Sadly, patience is not one of the attributes many investors possess. However, it is one of the most important qualities of successful investors. Impatience is not a virtue you should possess as an investor. The frantic and frenzied nature of stock markets make it difficult to be patient. However, great investors understand that they have to be in charge at all times. You cannot afford to get lost in the midst of a relentless market movement. Many people are trying to grab as much as they can, and you have to be active as well. However, you have to be passive in your activity. Being passive as an investor is not a state of inactivity, but a state of deliberate and logical investment approach. The operation of shares and stocks is actually slow, but most people are too fast because they can't wait to become the next successful investor. It is good to be ambitious, but you have to be patient to avoid falling into an investment pitfall. You see, before any successful investor sees real progress in their investing efforts, they will tell you that mastering these mistakes is critical. For instance, if you are too emotional and draw out money from your portfolio during downtimes, then you risk never having your money recover. If you try and time the market, you will fail more times than you succeed, since this investing strategy is not sustainable long term. Finally, lacking patience may be the biggest downfall of them all when investing for the long term, as you may take too many risks to try and accelerate your road to success. However, succeeding in your investing efforts becomes a lot easier when you have tried and true principles to follow, and the following 5 are ones you must master. Principle number 1, invest in what you know. Before investing in a stock, it is very important to understand what a company does and how it makes its money. Ever wondered why famous investors like Warren Buffett has always avoided investing in tech stocks? It's because he does not completely understand their business model. Instead, he sticks to what he knows. An example of this is Coca-Cola. Buffett has invested a ton of money into this soft drink giant because it's a business he can easily comprehend. People drink millions of bottles of Coke every single day, and since it is a consumable good, it means they will continue to have solid sales year over year, which is great as a shareholder in their company. Principle number 2, having investing criteria. When you are about to buy a stock or a bond, what characteristics does it need to meet for you to commit your money to it? Do you just invest money because a friend told you to, or do you have set metrics that need to be satiated first? Another principle that the rich always employ is investing based on criteria. These criteria may require that asset to be in a certain industry, have a certain dividend yield, or even have a minimum level of annual appreciation. While it might seem like a good idea to just base your purchasing decision on the stock price, this isn't always the best idea. In fact, Warren Buffett never makes the price of the stock the sole criteria of his buying decision. The reality is that sometimes great companies end up taking a price dip because of the market volatility, but that doesn't mean it isn't a stock you would want to pass up on. Principle number 3, capitalize on tough times. Generally, it's not recommended to time the market, and this is one of the mistakes I previously mentioned in this video. However, it is wise to take advantage of downturns in the economy. If you're a long-term investor, the reality is that you'll be fine whether you are buying in a recession or peak market. But during slower economic times, it may be wise to invest a little bit more effort to propel your money-making journey. What the rich do during these harsh economic times is be on the lookout for opportunities. Even the investing mogul himself, Warren Buffett, admits to being very active during economic downturns, as he knows that things will eventually turn around. Principle number 4, ignore short-term volatility. Investing in stocks can be quite stressful, which is why I mentioned earlier on that you must control your emotions when dealing in the stock market. The truth is that those who fare the best in their investing efforts are those who ignore short-term volatility and commit to the long game. In fact, Warren Buffett offers great advice on this exact topic, and says that you should only buy a stock if you are comfortable holding on to it in case the stock market shuts down for a decade. When you're holding a stock for the long term, it no longer makes sense to lose sleep over short-term price swings. Ignore the headlines about the trade wars, the government shutdown, and other chaotic news. Instead, focus on learning more about the businesses you are invested in and continue to seek out other investment opportunities. Principle number 5, identify your investor type. One important principle to live by when undertaking your own investment journey is to know the exact type of investor you are. In fact, the godfather of investing and teacher of Warren Buffett, Benjamin Graham, advised that investors know their investment selves. Graham referred to active and passive investors as enterprising investors and defensive investors, which means that there are really two paths when investing. The first option is to make a serious commitment in time and energy to become a good investor who equates the quality and amount of hands-on research with their expected return. This is the path of the active or enterprising investor. If this isn't your cup of tea, then your other option is to be a passive investor. When you're a passive investor, you should generally be happy with a possibly lower return. However, your time investment will also be less. Graham was heavily into the idea that the more work you put into your investments, the higher your returns should be. However, the reality is that most people don't have the time or the interest to become an expert stock investor, which is where index investing comes into play. Graham believed that passive investors, or defensive investors as he put it, could get an average return by simply buying the 30 stocks of the Dow Jones Industrial Average in equal amounts. In fact, both Graham and Buffett have said that getting even an average return, such as the return of the S&P 500, is more of an accomplishment than it might seem. The fallacy that many people buy into, according to Graham, is that if it's so easy to get an average return with little or no work through indexing, then just a little bit more work should yield a slightly higher return. The reality is that most people who try this end up doing much worse than average. In modern terms, the defensive investor would be an investor in index funds of both stocks and bonds. In essence, they own the entire market, benefiting from the areas that perform the best without trying to predict those areas ahead of time. In doing so, an investor is virtually guaranteed the market's return and avoids doing worse than average by just letting the stock market's overall results dictate long-term returns. One other important point to note is that some people are not investors at all. In fact, there is another group of stockholders who operate differently than an investor and still obtain profits through their efforts. This other group are speculators. Now, you may be wondering what the difference is between an investor and a speculator, and it's quite simple. An investor looks at a stock as part of a business, and the stockholder as the owner of the business, while the speculator views himself as playing with expensive pieces of paper with no intrinsic value. For the speculator, value is only determined by what someone else will pay for the asset. Speculating is generally unadvisable for the average person. It requires a very in-depth knowledge of the market and extreme emotional control. And when you can receive returns in the market without that level of stress and attention, then investing is typically the better path to take. In the end, investing is the number one way to build a fortune. However, as you've seen, there are traps that you must avoid, like being overly emotional, trying to outperform the market, and being impatient. And when you avoid these mistakes and employ the 5 investing principles I just went over, you will be set up for investing success. Thanks for watching. If you want to go from the life you have to the life you deserve, then hit the subscribe button now.